Do you know why 95% of investors lose money in the market? It's not because the market is unpredictable or rigged. It's because they throw their money into things they don't truly understand. That's the fatal mistake most people make. Peter Lynch, one of the greatest investors of all time, famously said, "Invest in what you know." It sounds simple, almost obvious, but very few actually live by it. When you invest in something you deeply understand, whether it's a company, an industry, or a product, you're not just guessing or following the crowd. You see the full picture. You understand how that business makes money, what challenges it faces, and what sets it apart from the competition. Most investors, however, get swept up by hot tips, buzzwords, or the latest can't miss stock everyone's talking about. They buy in without doing the homework. That's how you get burned, fast and hard. Imagine walking into a casino and betting your life savings on a game you've never played before. Sounds crazy, right? Yet that's exactly what millions do every day in the stock market. Peter Lynch's advice is a wake-up call. Before you invest a single dollar, make sure you can explain, in plain English, why that company is a smart bet. If you can't, don't invest. This isn't about chasing trends or trying to time the market. It's about having conviction because you know what you're putting your money into. So next time you see a hot stock tip or a can't miss opportunity, pause and ask yourself, do I really understand this? Or am I just hoping to get lucky? Because investing without understanding is gambling, and that's not how you build lasting wealth. Don't try to predict the market. If you thought investing was about predicting the next big market move or timing every dip and peak perfectly, think again. Peter Lynch, who mastered market cycles over decades, delivered a harsh truth. You cannot predict the market. It's tempting to believe you can spot the exact moment the market will crash or soar. But even the most seasoned pros and legendary investors get it wrong, often. Trying to guess what the market will do next is like chasing lightning in a bottle. The market is unpredictable, chaotic, and influenced by millions of factors no one can fully control or foresee. Lynch's real genius? Focusing on something far more reliable, finding great companies and holding them for the long term, regardless of short-term market noise. Markets will always fluctuate, but businesses with solid fundamentals, clear competitive advantages, and strong management will survive storms and grow over time. The biggest profits don't come from timing the market perfectly. They come from time in the market. The harder you try to beat the market by guessing, the more you risk costly mistakes, panic selling during a dip, or chasing prices at their peak out of fear of missing out. Instead, Lynch urges investors to focus on what's controllable, knowing the companies they invest in, assessing long-term potential, practicing patience and discipline. Investing isn't a sprint, it's a marathon. The winners are those who stay in the race, no matter how rocky the path. So next time you wonder, is now the right time to buy or sell? Remember, you don't need to predict the market to succeed. Just pick strong companies and hold on tight. Look for hidden gems, the small, overlooked stocks with huge growth potential. In a market flooded with noise and hype, the real winners often fly under the radar. Peter Lynch called these opportunities 10-baggers. Stocks that multiply tenfold in value over time. These aren't the giant, headline-grabbing companies everyone knows. They're smaller, quieter businesses quietly building their future, often ignored or dismissed by most investors. Why? Because they're not flashy, not hot, and sometimes too small to grab Wall Street's attention. But that's exactly what makes them gold mines for the patient and observant investor. Lynch's genius was spotting these hidden gems early, before the crowd wakes up and pushes their prices sky high. The secret? Deep research, understanding the company's fundamentals, its market, and its potential to grow in the years ahead. It's like discovering a tiny seedling in a dense forest. Most people overlook it, but with time and care, it grows into a towering tree. The lesson is clear. Don't just chase the popular stocks everyone's talking about. Train yourself to dig deeper. Seek out those small companies with strong potential that the market has forgotten. Because the biggest wealth often comes not from following the herd, but from finding and holding the hidden gems others miss. Patience isn't just a virtue in investing, it's a weapon. We live in an age of instant gratification, one-click trades, real-time updates, The dopamine rush of checking your portfolio every hour. Everyone wants to double their money overnight. But here's the cold truth Peter Lynch understood better than most. That mindset is poison to real investing. True wealth isn't made in moments. It's made over years, sometimes decades. Lynch wasn't just buying stocks, he was buying time, the most powerful force in finance. He believed that great companies don't reveal their greatness in a quarter or a year. They unfold it slowly, like a story, chapter by chapter. Their value compounds quietly. Their profits grow gradually. Their vision turns into reality, but only for those with the patience to wait and watch it happen. When you sell too early, you rob yourself of the most magical part of investing: compound growth. Lynch called it the eighth wonder of the world, and for good reason. It's not the first 10%, 20%, or even 50% that builds life-changing wealth. It's what happens when a good investment is allowed to grow untouched, unshaken by panic or short-term noise. The market tests you. It will shake your confidence. Stocks will dip. News will rattle you. You'll be tempted to sell. Everyone around you will be chasing trends, flipping positions, jumping ship at the slightest wave. But here's where Lynch stood apart, and where smart investors stand strong. They hold. They trust the process. They let time do what time does best: multiply value. Because every legendary portfolio was once filled with ordinary stocks held by extraordinary patience. So the next time you feel the urge to sell because of boredom, fear, or noise, remember, you're not just investing in a stock. You're investing in the future of a business and in your own ability to wait for that future to arrive. Peter Lynch didn't win because he was the fastest. He won because he understood the market rewards those who wait. Diversify, but don't dilute. There's a dangerous myth in investing. The more stocks you own, the safer you are. But Peter Lynch, a man who managed one of the most successful mutual funds in history, knew better. Diversification isn't about owning everything. It's about owning enough of the right things. Lynch recommended holding somewhere between 15 to 20 solid companies. Why? Because too few stocks leave you exposed to concentrated risk. One bad decision can wreck your returns. But too many? That's a different kind of danger. You lose control. When your portfolio starts looking like a grocery list, 50, 100, even 200 names, what you're doing isn't investing. It's collecting. And worse, you stop truly knowing what you own. Here's the Lynch difference. He didn't just own stocks. He understood them. He followed their stories, tracked their fundamentals, studied their management, and monitored their long-term vision. You can't do that with a bloated portfolio. Imagine trying to keep track of 100 businesses, each with their own risks, sectors, financials, news cycles, and competitive dynamics. It's not diversification. It's chaos disguised as safety. Lynch believed that real diversification means balancing risk, not drowning in it. It means building a portfolio where every stock earns its place, where you know why it's there and what you expect from it. Owning more stocks doesn't protect you if you don't understand them. But owning a focused set of high-quality companies, ones you've researched deeply and believe in, gives you the clarity, control, and confidence needed to hold through good times and bad. So before you add that 37th stock, just because someone on Twitter said it might go up, pause. Ask yourself, do I know this business? Do I believe in its future? Am I watching it closely enough to act when needed? If the answer is no, it might not belong in your portfolio. Because as Lynch taught us, a well-managed 20-stock portfolio will beat a blind 100-stock portfolio every single time. Every stock has a story. If you don't know the story, you don't know what you own. Peter Lynch didn't buy tickers. He didn't buy charts. He bought stories, real businesses, with real futures, solving real problems. Before putting a single dollar into any company, Lynch would ask one simple but powerful question. What's the story behind this stock? What does the company actually do? How does it make money? And how will it make more in the future? What sets it apart from competitors? Is the industry growing, stagnant, or dying? Who's running the business? And do they think like owners? If you can't answer those questions clearly, you're not investing. You're gambling. Most people get caught up in the price. They ask, is this stock cheap? But Lynch asked, Is this business valuable and misunderstood? Because price is only noise without context. A stock can drop 30%, but if the story is still strong, it could be a gift. A stock can soar 50%, but if the story is broken, you may be the last one holding the bag. Lynch didn't need Wall Street research to understand a business. He looked around. What stores are people shopping at? What brands are growing quietly in the background? What trends are reshaping how we live, work, and spend? He believed ordinary investors have the power to spot extraordinary stories long before Wall Street catches on if they're paying attention and doing the homework. Owning a stock without knowing the story is like driving blindfolded. You don't know where you're going, and worse, you won't see the crash coming. But when you know the story, when you understand the business, believe in its future, and trust its leadership, then short-term noise becomes just that, noisies. You hold with confidence, you buy more when the market panics, and most importantly, you stay focused on the reason you bought it in the first place. Because behind every great investment is a great story. Numbers don't lie if you know how to listen. Peter Lynch never relied on flashy headlines or market hype. He trusted the numbers, the raw, unfiltered heartbeat of a business. Before investing in any company, Lynch would dive deep into its financial statements, not to memorize ratios, but to understand one core truth. Is this business financially healthy and built to grow? You don't need a PhD in accounting to be a great investor, but you do need curiosity. You need discipline. And above all, you need to ask the right questions. Is the company actually making money or just burning cash? Look at net income, but go deeper. How much of that profit turns into real, usable free cash flow? Is revenue growing year after year or stagnating? Growth isn't everything, but consistent, organic growth usually means the business is doing something right. What's the debt situation? Debt can fuel expansion or bury a company when times get tough. Know the difference. Are profit margins stable or shrinking? Strong margins suggest a competitive edge. Shrinking ones could signal trouble ahead. Is the company reinvesting in itself or just pleasing shareholders in the short term? Great companies plant seeds for future growth in R&D, in innovation, in expansion. Lynch wasn't impressed by complex financial engineering or sky-high projections. He looked for clarity, consistency, and truth in the numbers. He believed a company's financials should tell a story just as clearly as its product or brand. And most importantly, he understood that great financials today are no guarantee of greatness tomorrow, unless they're backed by sound strategy, honest leadership, and a long-term vision. Anyone can fall in love with a company's product. But Lynch asked, do the numbers love the business too? So before you jump on the next hot stock tip or trending name, pause. Open the annual report. Read the income statement. Follow the cash. Because the truth is, the most successful investors aren't just storytellers, they're financial detectives. And as Peter Lynch proved, if you follow the money patiently, wisely, and with a clear head, it can lead you straight to wealth. The market is not a casino unless you treat it like one. Peter Lynch had a simple rule when markets panicked. Don't just watch the price, watch the business. It's easy to get spooked when a stock drops 20%, 30%, even 50%. The headlines scream. The forums light up. Everyone suddenly becomes a prophet of doom. But here's what Lynch knew, and what most investors forget. Great businesses don't become worthless overnight. Sometimes prices fall for no good reason. Bad news that's already priced in, a rough earnings quarter, macro fears, herd panic. But the question you must ask yourself isn't, why is the stock down? It's, has the story changed? If the business is still solid, if cash is flowing, the fundamentals are intact, and the long-term vision remains clear, then a falling price isn't a danger. It's a discount. That's where Lynch thrived. While others were running for the exits, he was calmly buying more of what he understood. He didn't try to time bottoms. He didn't catch falling knives. He simply bought great companies when they were unfairly cheap and waited. Because long-term wealth isn't built by reacting. It's built by believing in businesses, in management, in strategy, even when prices stumble. Of course, not every falling stock is a hidden gem. Some deserve to fall. That's why you don't just look at charts. You dig into earnings calls, balance sheets, and market position. But when you've done the homework, when you know the company inside out, when you can explain, in plain English, why it'll thrive in 5 years, then price drops become a gift, not a threat. Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves." So next time panic strikes, remember, stocks don't bleed, emotions do, and the best investors know when to step back, zoom out, and hold on. The moment you think you know it all, the market will prove you wrong. Peter Lynch wasn't just a legendary investor, he was a lifelong student of businesses, trends, people, and numbers. Why? Because in the world of investing, complacency is deadly. The economy evolves, technology disrupts, consumer habits shift. What worked yesterday might collapse tomorrow, and what looked irrelevant last year could become a billion-dollar wave today. That's why Lynch made it a habit to constantly learn. Not in theory, in real time. He read annual reports like novels. He walked through shopping malls to see what people were buying. He followed news, earnings, habit, and management changes, like a detective follows clues. He didn't sit in an ivory tower. He stayed on the ground, curious, sharp, humble. And he understood a critical truth. You don't have to predict the future, but you better not ignore the present. The best investors aren't those with the highest IQ. They're the ones who stay engaged, who keep asking questions, who aren't afraid to admit when the world has moved on. So what does that mean for you? It means making research part of your routine, reading quarterly reports not because it's required, but because it gives you an edge. Watching how industries shift, how competition emerges, how management adapts, not as noise, but as signals. Because behind every market move is a story, and behind every story is a lesson. If you're not learning, you're guessing. If you're guessing, you're gambling. And if you're gambling, the house always wins. So read more, ask more, stay open. Not because you need to know everything, but because you need to keep knowing more. That's how Peter Lynch stayed ahead. Not by being the smartest in the room, but by being the most informed. And in investing, information is compounding too, just like your money. If you're investing based on what everyone else is doing, you're already too late. That's not just a warning, it's a reality check. Peter Lynch didn't build a legendary career by following crowds. He did it by thinking independently, by questioning consensus, by trusting his own research when others were busy chasing trends. Because here's the truth. The crowd is loud, but rarely right. When a stock becomes a hot tip on every forum, it's usually too late. When everyone's rushing into a trend, the upside has already been eaten, and the risk is all that's left on the plate. But Lynch, he believed in quiet conviction. He found opportunities no one was talking about. He bought when it was boring, he held when it was lonely, and he profited when others finally woke up. Investing isn't a group activity. It's personal, it's thoughtful, it's you, making sense of the numbers, the story, the future. Lynch always asked, do you understand the business? Do you believe in it? Can you explain it to a fifth grader? If yes, buy it. If not, don't. Simple, not easy, but timeless. And that's the last lesson. Your best edge in investing is you. Not algorithms, not headlines, not hype, just your eyes, your mind, your discipline. So next time the herd moves left, stop, think, question, decide for yourself. That's not just how you invest like Peter Lynch. That's how you win like Peter Lynch. If this series has opened your mind, don't stop here. There's more where that came from. Hit subscribe to the channel so you never miss a beat. Turn on notifications. Share with a friend who needs clarity in the chaos. This is investing for thinkers, for learners, for leaders. See you in the next deep dive. And remember, buy what you understand. Hold what you believe. Ignore the noise.